In today's video, we are going to continue the discussion on Social Security benefits and specifically how and when Social Security benefits are taxed. So when I say Social Security taxation, I'm referring to your actual Social Security benefits being taxed. I'm not referring to the FICA payroll tax, right? So during your working career, you're paying into the system through your FICA tax 6.2%, goes to Social Security. Your employer pays another 6.2%. And if you're self-employed, you end up paying both, right? 12.4. That is not what I'm talking about. We are talking specifically about the taxes on your actual benefits in retirement. Whether your Social Security benefits will be taxed or not has to do with your provisional income. You know, provisional income is an IRS term, and the provisional income formula is what is used to determine if your Social Security benefits will be taxed or not. To know how much of your Social Security benefit may or may not be taxed has to do with provisional income. Okay, now provisional income is an IRS term, and it is a formula. If you take a look at my screen here, this is the provisional income formula that is used to determine how much of your Social Security benefit will be taxed. Now, this taxable bucket, what that represents is any investments that you may have that are taxable. So that could represent any gains from stocks, bonds, mutual funds. It would include any earned income if you had earned income. It could include rental income. It could include interest earned off of municipal bonds. Even though municipal bonds are exempt from federal tax, they are not exempt from the provisional income calculation. And so you have all of your taxable money, right, found in this taxable bucket. And then we add that to the tax deferred bucket. So your tax deferred bucket would represent any assets that you have, such as 401k, IRA, a pension. And then they take 50% of your annual Social Security benefit. They add that all together, and that is your provisional income number. So if you have no retirement accounts, you have no pension of any kind, you have no earned income, then your Social Security benefit is not going to be taxed. But if you do, and if you've done a good job of saving and preparing for retirement, it is highly likely that your Social Security benefits will be taxed. So if you're single and your provisional income exceeds $25,000, then 50% of your Social Security benefit will be taxed as ordinary income. If your provisional income exceeds $34,000, then 85% will be taxed as ordinary income. And then for married couples, the numbers are $32,000 and $44,000 respectively. So let me ask you a question. What do you think is the greatest single contributing factor to whether your Social Security is taxed or not? And the answer is having too much money in your tax deferred bucket. Meaning that throughout your working career, you did the 401k, tax deferred, tax deferred, tax deferred, all your contributions, or into an IRA where it's all tax deferred money. Because when that money comes out, when you take distributions in retirement, it is 100% taxed as ordinary income. As of 2019, these are our tax brackets. And so as you look at this, think of this kind of like a measuring cup. And if you were to pour some liquid in, it comes down to the bottom and it fills up. And so as you pour in your income, right, into this measuring cup, some of your income will be taxed at 10%, some at 12%, some at 22%, and so forth, depending on how much income you have. Now, when it comes to provisional income and Social Security tax, what they do is they take whatever your income is. So if let's say you're in the 22% tax bracket, they're going to dump in your provisional income number, and it's going to land right on top of your other income. So in other words, if you're in the 22% tax bracket, then 85% of your Social Security benefit is going to be taxed, it's going to be taxed at your highest marginal bracket. So in that case, you'd be taxed at 22%. So let me just show you a hypothetical example. Let's say we have Jack and Jane, and they have a provisional income that exceeds $44,000. And let's assume that they have a Social Security benefit of $30,000 per year. That means 85% of the $30,000, which would be $25,500, is going to be treated as ordinary income. And Jack and Jane happen to be in the 22% tax bracket, which means that their federal tax on their Social Security benefit would be $5,610. The problem with this is most people don't see this tax coming. I refer to this as a stealth tax because it's very commonly overlooked. And so if you have planned out retirement and anticipated what your Social Security benefit would be, only to find out that it's effectively being reduced through taxation, you now have less retirement income than you had thought that you had, right? But what happens in the real world is if you now have planned on this income and now you realize you have a shortage, let's say $5,610 in this case, let's assume that they're in a 20% total taxes including federal and state. How much would Jack and Jane have to pull out of their tax deferred account or to pull out of an IRA, for example, to compensate for the shortage? And the answer is $7,792. So they'd have to pull out enough to pay the tax and to compensate for the shortage. So now, here we have them pulling out $7,792 every year throughout retirement that was not really anticipated. That can cause your portfolios to deplete ahead of schedule. What is the lost opportunity cost on $7,792 if you were to be able to avoid it? If we take $7,792 per year at 8% over 20 years, we're approaching $400,000. So there's a lot of money at stake. The important thing that I want you to know is that avoiding Social Security tax is possible for most people. Now, not everyone's going to be able to completely avoid it, but most people can. But you have to plan for it, and you have to use some strategies to make that happen. Now, as I work with my clients in creating holistic financial plans, what I can tell you is just that one strategy alone of avoiding Social Security tax can add 5 to 7 years of life on your portfolio. Because if your Social Security benefit is being taxed, it kind of has this snowballing effect, and it can really deplete your assets more quickly. So in conclusion, if you have a 401k or an IRA or a pension, your Social Security benefits are most likely going to be taxed. And it has a very negative impact on the sustainability of your retirement portfolio. And what I can tell you is that there are strategies and there are ways to avoid having your Social Security taxed. Now, again, not everyone can avoid it completely, but most people can with proper planning. The strategies are often going to include Roth conversions. Once you get money inside of a Roth account, that money from that point forward is tax-free. It is not subject to required minimum distributions. It does not contribute to the provisional income, which causes Social Security benefits to be taxed. And that income is essentially tax-free forever. And so you can't do Roth conversions too fast or too large, because then it shoots you up the tax bracket and you end up paying too much in tax. And so the strategies are multi-year. It takes a little bit of time to get your tax deferred accounts properly shifted into a tax-free bucket so that you can ultimately avoid Social Security tax. And if you can't completely avoid the tax, you can at least reduce it significantly. So the strategies of actually how to do that, we will cover in a different video. But for now, I just wanted to point out the importance of not overlooking taxes on Social Security benefits. Thank you. Please subscribe to the channel, and I look forward to seeing you in the next video.